Hey, if you've ever watched the stock market soar while people around you were losing jobs, struggling to pay rent, or shutting down their businesses, you've probably asked yourself, what the hell is going on? You're not crazy. You're not missing something. In fact, one of the greatest investors of all time, Warren Buffett, has been saying for decades that the stock market is not the economy. And once you understand why, you'll never look at a market rally, or a market crash, the same way again. Stay with me, because by the end of this video, you're going to understand something that most people, including some so-called financial experts, never fully grasp. Let's start with the most jaw-dropping example in recent history. March 2020. COVID hits. The entire world shuts down. Unemployment in the US spikes to nearly 15%, the highest since the Great Depression. Businesses close. Airlines, hotels, restaurants, wiped out almost overnight. The economy? Absolutely devastated. But here's what's wild. The stock market crashed for about 5 weeks, and then started going back up. By December 2020, the S&P 500 had not just recovered, it had gained 16% for the year. Meanwhile, millions of people were still unemployed. Small businesses were still shuttered. GDP had cratered. How is that even possible? This is what economists call the Great Disconnect. And it's the exact phenomenon Warren Buffett has been pointing to for years. Buffett once said, "The stock market is designed to transfer money from the active to the patient." But more importantly, he's repeatedly emphasized that stock prices reflect future expectations, not current reality. The economy tells you where you are. The stock market tells you where investors think you're going. That's the first key insight, and it changes everything. Before we go deeper, let's get clear on terms, because a lot of people confuse these two things because no one ever properly explains them. The economy is the total productive activity of a country. It's measured by GDP, gross domestic product. It includes consumer spending, groceries, rent cars, business investment, government spending, net exports. It's measured quarterly. It reflects what already happened, real jobs, real wages, real goods and services produced. The stock market, on the other hand, is a marketplace where shares of publicly listed companies are bought and sold, based on what investors believe those companies will earn in the future. Notice the difference? Economy equals past and present. Stock market equals future expectations. And here's where it gets even more interesting. The stock market doesn't even represent the full economy. The companies listed on the stock exchange are mostly large corporations. Small businesses, which make up the backbone of any economy, are not on the stock market. In the US alone, small businesses account for nearly 44% of economic activity, but they have zero representation on the S&P 500. So when the stock market is up, it could mean large corporations are thriving, even while Main Street is struggling. Warren Buffett learned something crucial from his mentor Benjamin Graham, the idea of Mr. Market. Imagine the stock market as a person. Every single day, Mr. Market knocks on your door and offers to buy your shares or sell you his, at whatever price he's feeling that day. Some days, Mr. Market is euphoric. He's optimistic about the future, so he offers you a high price. Other days, Mr. Market is depressed. He's scared, anxious, reading bad headlines, and he's willing to sell his shares for almost nothing. Here's the thing. Mr. Market's mood has very little to do with the actual value of the businesses. The economy can be doing great, but if Mr. Market is scared of inflation, or rising interest rates, or a war halfway across the world, prices fall. The economy can be in recession, but if Mr. Market is excited about a vaccine, a tech breakthrough, or a stimulus package, prices rise. This is why Buffett famously said, "In the short run, the market is a voting machine. In the long run, it's a weighing machine." Short term equals emotion, sentiment, speculation. Long term equals actual business value and economic fundamentals. The voting machine is loud and dramatic. The weighing machine is slow and boring, but it's always right, eventually. Here's another massive reason the stock market and economy diverge, and it's one Buffett has spoken about extensively. Interest rates. When the economy struggles, central banks, like the U.S. Federal Reserve, cut interest rates and pump money into the system. This is called monetary stimulus. Lower interest rates mean borrowing is cheap, companies can take on cheap debt to grow. Bonds become less attractive, so investors move money into stocks. Future earnings are discounted at a lower rate, making stocks appear more valuable. So paradoxically, a struggling economy can trigger conditions that make stock prices go up, because the Fed steps in to rescue it. This is literally what happened in 2020. The Fed slashed rates to near zero and injected trillions of dollars into the financial system. Stocks shot up, not because the economy was great, but because money had nowhere else to go. Buffett has a brilliant metric for this, called the Buffett Indicator. It measures the total market cap of all U.S. stocks divided by GDP. When this number is very high, stocks are expensive relative to the actual economy, a warning sign. In 2020 and 2021, the Buffett Indicator hit record highs, precisely because the stock market had disconnected from economic reality. There's a deeper, more uncomfortable truth here, and Buffett, to his credit, has acknowledged it. The stock market primarily benefits those who own stocks. In the United States, the wealthiest 10% of households own approximately 89% of all stocks. The bottom 50%? They own less than 1%. So when the market rises, even during a bad economy, the gains go almost entirely to the already wealthy. This creates a situation where the rich get richer during a recession. Workers lose jobs and wages. Yet headlines scream, "Markets at all-time highs!" And people are confused, frustrated, and feel like the system is rigged. It's not exactly rigged, but it is built in a way that rewards capital over labor. That's the structural reality. And understanding it helps you make better decisions about your money, because you can choose to become someone who benefits from the market, rather than someone left behind by it. So what do you do with all of this? Here's Buffett's practical wisdom. First, don't use the stock market as a barometer of how the economy is doing, or vice versa. They tell different stories. Second, don't panic when the economy looks bad but the market is rising. And don't assume everything is fine just because the market is at record highs. Third, invest in businesses you understand, with strong fundamentals, at reasonable prices. The market's short-term mood is noise. Long-term business value is signal. Fourth, think in decades, not days. Buffett's favorite holding period is forever. Because the weighing machine always catches up to reality, you just have to be patient enough to wait. And finally, start investing. Because the cruel irony of the stock market disconnect is that those who don't participate get left further and further behind. You don't need to be rich to invest. You just need to start. The stock market and the economy are like two people in the same car. One's looking at the GPS showing where they're going, the other's looking out the window at where they are right now. Sometimes they agree. Often they don't. Warren Buffett figured this out early, and it made him one of the wealthiest people in history. Now you know it too. If this video gave you even one new idea about how markets really work, hit that like button. It genuinely helps more people find this content. Subscribe if you want more videos that break down complex money topics in plain English. And drop a comment below. Have you ever been confused by the market going up during a recession? I'd love to hear your story. See you in the next one.